Harsha Upadhyaya, Chief Investment Officer for Equity at Kotak Mahindra AMC, joins us on the show. Harsha, good morning. Thanks much for joining in. Well, DIs may have been the saving grace this last month, Harsha, because the selling spree that the FIs seem to be on is very rampant. The question, though, is, Harsha, that while the SIP model might be okay, if you were given a choice, looking at the way the economic conditions are and the commentary from the large cap names now about consumption stroke economic factors, is it prudent to maybe sit on some bit of cash in your portfolios if the mandate allows you?
Good morning, Neeraj. Yes, what you have been saying is true. The sentiments have been very weak. Foreign investors have sold close to $1.5 billion this month. And the commentary that is coming from company managements have also been pointing to further weakness in the economy. Having said this, clearly this is a time where you should not be looking at what can be the short-term returns, but you need to build a portfolio for a longer term. And as long as valuations are in your favor and if you're not taking too much risk at this point of time, that should work for you. And that's what has been our strategy. Yes, the cash levels may have gone up a couple of percentage points in some of the funds where we have seen some inflows. But broadly, our mandate is to be invested at all points of time. So to that extent, in every market condition, we'll look for companies which, in our opinion, will be better than the rest of the market, and that's what pushes us into kind of stocks or sectors that we are looking at this point of time.
So there's no need really to actually go ahead and increase cash holdings at this point. There is still opportunities of interest, Harsha?
As a policy, we don't take too much of cash calls in our portfolio because we believe that once the investor has put his money into equity funds of ours, the mandate is to invest in equity, and we should not further do asset allocation with that money. With that in mind, all our funds have a maximum cash limit of 7.5%. And in some of the funds where we have been getting consistent flows, the cash levels today would be somewhere between 5 to 7%. In the rest of the funds, it could be somewhere around 2 to 3%. So that's what the cash levels are at this point of time.
Not specific to your fund, what I wanted to gauge from you is, for a retail investor at this point who's finding it difficult to maneuver this market, will it be more prudent to have cash conservation instead of cash destruction by just investing in any of the other stocks which don't seem to have a bottom currently?
It's always very difficult to time the markets. So whether it is retail investors or experts, nobody is able to really time the markets at inflection points. And we believe that if you look at the broader markets today, the valuations have been lower than the average valuations for last 10 years. Yes, the large caps maybe are still at a higher valuation than the long-term average, but broadly market has corrected nicely over the last 18 months. So to that extent, I don't think one should be panicking when the markets are showing weakness at this point of time. Over the next 6 to 9 months would be the time period to really get invested into the market with a investment horizon of maybe 3 to 5 years. So we are advising investors to do staggered and disciplined investments over the next few quarters, and also keep some gunpowder dry so that if there is any additional volatility that you see in the market because of any event, then you could invest whatever you have kept aside. So that's what we are proposing at this point of time.
Harsha, anything that surprised you so far within this earnings season in terms of any management commentaries, any results that came out from specific sectors? I mean, we've seen consumption, while much of the negative commentary was already spoken about in the previous few quarters. This quarter, actually, with regards to, just setting aside a few that just came out yesterday, I don't want you to get stock specific, but do you think that most of the companies have pretty much performed in line with what the expectation was?
Most of the results have been in line or slightly lower than expectations. So to that extent, this ongoing earnings season has not really given any positive triggers for the market. And that's what has kind of increased nervousness in the market, because one, the headline earnings growth that the market is expecting is very high, which is at about 25-26% year-on-year growth. And bulk of that is going to come from corporate banks, where we do not really see a reason to believe that there can be disappointments at this point of time. But what is worrying to us is the consumption sector accounts for nearly 10 to 15% of the incremental growth that everyone is expecting for the financial year 2020. And that's where I think most of the disappointments would be coming through. And that's what is kind of putting further pressure on some of the consumer-driven sectors at this point of time. But by and large, there have been no real positive surprises during the season.
All right, so does that growth number of 25% get challenged now? I mean, the start, we've not gone off to a really flying start in terms of the earnings season. So, with each quarter that proves to be a disappointment, that adds more pressure to the upcoming quarters for delivery and performance. So, keeping that in mind, does that challenge that figure of about 25-26% growth?
Yes, in our opinion, the earnings growth for the year could be at best 17-18%, and that too led by corporate banks, which in our opinion would contribute to nearly 55 to 60% of the incremental growth during the year. If you strip that out, then overall earnings growth could be in the region of 5 to 7%, and that's what is not giving much confidence to most investors, because if you strip out the reversal that's happening in terms of provisioning levels for corporate banks, then the overall market is not really showing any different growth than what it had seen in the last couple of years. And also the pockets where there was higher growth in the past are all suffering today, and that's where the market is.
Harsha, actually the follow-up to that, while there is a quest for identifying which would be the small bank that could become larger, and therefore we need to follow up on that, this quarter has shown that exercise might prove futile, because nobody quite anticipated high quality managements and high quality banks like DCB or RBL Bank to do what they have done. Today's numbers from IDFC First Bank are also a washout. You may buy into a stock, watch it rise for 2 quarters, 3 quarters, and then one bad day can wipe out that entire piece, and not because of the bank's individual issues, but because of the system-wide issues. Is it prudent to stick to larger names right now as opposed to try and go out searching for the mid-cap banking name?
Without getting into stock-specific concerns or issues, I would say that when economy is going through a downward trend, there will be bullets flying all over and all around, and that's what is happening with some of the banks, where there has been an exposure to companies which are kind of at a distressed state today. And that doesn't mean that all small banks or mid-sized banks are bad, and also it doesn't say that all large-sized banks are good, because the issues would be dependent on what kind of loans that they have lent, and which are the companies, which are the sectors, where is the downward pressure from the economy in that sense. So our call on the banks would be that we would continue to stick to the private sector banks, where we believe that while there have been issues in a couple of cases, but overall the underwriting standards are much better than the public sector banks, and past asset quality issues are also not as high as what you would see in public sector banks. And similarly, in the NBFC space, we have been underweight, and that call continues even going forward, because we are not really seeing any normalization in that particular basket.
Harsha, the other pocket is cement. Now, Ambuja, I'm not asking for a stock-specific question again. Ambuja comes out in numbers today. If ACC's numbers are any indication, the pricing power still exists with the cement companies, even if volumes are not shaping up. So costs coming off, pricing staying okay, would that compensate for low volume growth, and would valuations give investors a chance to make money in this pocket?
See, for the entire 2018 calendar year, pricing issues were the main concerns for the market. While the volume growth was very, very strong, the pricing was not coming through. That situation has changed quite considerably during 2019, and while off late we have seen some issues in terms of the volume growth sustaining those high teen levels, but overall pricing power has come back to the industry, and we have to wait and see whether in a lower demand scenario, this pricing power will continue. But as far as April to June quarter results are concerned for cement companies, most of the companies in the sector would obviously announce very good results in our opinion. We'll have to wait and see how this particular quarter and the next few quarters shape up in terms of the volume growth. But as far as we are concerned, we are playing cement for a multi-year cycle, and we believe that since the new capacity additions are far and infrequent, we will continue to see operating rates going up. So there will be quarterly movements, there will be regional mismatches, all that. But overall, from a longer term perspective, we believe that both volume growth and pricing power will continue to be in favor of some of the large players in the industry, and those would be the ones where wealth will get created over the medium to long term.
All right. Harsha, so far the defensives have played out okay. I mean, they've conserved capital. I'm talking about IT in particular. The currency at 69, it's been perched there for some time now. There's not been much of volatility even with regards to the currency. We've seen what Infosys and TCS have done, and many of the other larger IT companies. What's the sense with regards to growth on the operational front? And while we're talking mainly about those low single-digit, the high single-digit growth numbers, do you see that even though we're not seeing very exceptional growth numbers, that is still a pocket to be in?
True, but I don't think as a sector it will be an overweight sector for us because we still see that from a valuation perspective, many of the mid caps in the IT sector are at a higher level, which may not be sustained, given that there is no tailwind for the margins or for the business in general. So you have to be stock specific in terms of picking likely winners from this pocket is what we think.
Okay. The other one that, since you already spoke about cement, I want to dwell a little more on the commodity side. Will you be looking at metals in a different light now? We've seen, there has been some amount of pickup in pricing. But the overall cyclicality of it is something that probably keeps investors away. Would you see things changing now materially for metals?
Currently, we are maintaining underweight position in metals because there are too many moving parts. One, global demand has been in question. It's been getting moderated in every quarter. And if you look at US-China trade policy, there are question marks in terms of tariffs and how it's going to impact overall global demand and supply in terms of commodities. So, and most of the commodity players in India also have high leverage on their books. So to that extent, I think while there may be value at this point of time, it's very difficult to take a large bet on that particular pocket, given where the overall global economy is and where our liquidity scenario is. So we are maintaining underweight stance on metals.
Let's talk about autos now, the big pain point that's been there for some time now. Despite some managements coming out and giving commentary with regards to August being a turnaround, it doesn't look so. The prep towards moving towards August is not really worked out as planned. Would you believe that the pain would last a little longer than anticipated now?
Definitely, we believe that this festive season is unlikely to be a great one because there is inventory at most of the manufacturers' side, and also we have done several channel checks with distributors spanning passenger cars, two-wheelers and other automobile segments, and everywhere there is more inventory than what manufacturers are holding at this point of time. So to that extent, I think inventory correction is going to take time, and we don't see a sharp V-shaped recovery in this particular segment.
Okay, Harsha, one final question from my end really. When we look across the spectrum, the pockets that have corrected the most, in addition to autos, are some of the slightly sketchy quality NBFCs. Now, we've spoken about the large banks, we've spoken about the mid-sized banking space as well. Would the same hold true for the financing companies, because they are showing some chinks in the armor, but the correction in the prices has been quite dramatic? Would you go out shopping in that space, or are you leaving it completely alone?
No, we are not looking to add to our NBFC exposure. We have very few names where there has been no funding constraint. The asset qualities have been stable, and there has been no asset liability mismatch in their books. So those are the NBFCs that we are holding today. And even with the fall in prices, we are not really looking at taking some bets in NBFC segment other than what we are holding.